It takes us to our talk of the tape. Can stocks get back on track, and can this rally now resume? Let's ask our panel. Cameron Dawson, Chief Investment Officer for NewEdge's Wealth. Adam Parker, the founder and CEO of Trivariate Research, a CNBC contributor. Both are here at Post 9. It's nice to see you both.
Great to be here.
Cameron, to you first. Are we all right now? I mean, we were worried. These rates have been backing up a lot, and we're worried about inflation moving higher and rates moving higher, and we did get that relief today, and the market loves it.
Yeah, we did think that rates moved a little bit too far too fast. Look at the 2-year. It traded up to 4.4%, which is just slightly below where the current Fed funds rate is at 4.5%, which effectively said the bond market was starting to price in the risk of further hikes. And so you get this slightly softer than expected inflation data, which allows you to have this big relief rally, mostly in the interest rate sensitive parts of the market, which you're seeing the Russell 2000 outperform so much on that. Doesn't mean that we're necessarily out of the woods for things like small caps in the volatility that they've been experiencing, but the sigh of relief is welcome.
Can we take a chill now on this whole the Fed is not going to do anything? Oh my gosh, they may actually hike before it's all said and done because of what the prints were today. That Goldman Sachs Asset Management today, while today's release is likely insufficient to put a January cut back on the table, it strengthens the case that the Fed's cutting cycle has not yet run its course. I feel like we had gotten to the point where we were like, oh my God, they might not do anything anymore.
Yeah, I guess with some perspective, I'd say I don't know if it matters. Meaning, at some point, if you think the Fed's half done, 2/3, 3/4 done, you just can't argue you have as much of the accommodation in front of you as behind you. So I don't think we're as bullish as we were a year or two ago. We could say, wow, we just started the cycle. The Fed's going to be there. The multiple. What got a little weird to me was the market was going up late last year, even when people were still hawkish. So today makes sense. You get dovish, the market goes up a little bit. But I don't know if we're going to get only dovish data points for the next 6 months. If we do, it means the economy's disappointing. So I would say there's pillars to the bull case. They look less interesting to me than and less, lower probability than they did 6 months ago. But, at least for now, people aren't going to think they're going to hike in the first half of this year.
But what if we're getting so-called hawkish data points for the right reason? What happens if growth remains strong, and then if inflation remains where it is, or even ticks maybe down?
Yeah, the stock market goes up.
Good,
Answer
right?
that question: the stock market goes up. Yeah.
I think, why isn't that the base case?
I look at the world right now and I say, what way to be super excited about equities 2 years ago and a year ago? I had early phase of the Fed, no longer true. I had massive U.S. Deficit, which really was a fiscal stimulus. Now I got these guys coming in. They're going to look to reduce that and maybe be more efficient with that. I had a dream of a China stimulus. That looks less interesting. I had some bull things now that I didn't have before. Massive potential M&A cycle, less regulation. I get that. And maybe some earnings proof cases on AI.
You think you're going to have fiscal stimulus through re-upping tax cuts, if not even giving more tax cuts?
Well, I think it takes less hikes off the table more than it takes lower rate, taxes from here. So I think that's bullish skew. But I'm just saying, if we're looking at all the things that make you bullish, margins are up a lot. I think I need revenue acceleration now. And I think what got in the price after the red sweep a little bit was more revenue acceleration than we're likely to see. So I'm not saying it's like sell right now. I'm just saying we're going to chop around until we get a little bit more comfortable that your base case you're painting out, which is that growth is okay and inflation is that's possible. But I would say it's less upside than it was a year ago.
Well, I mean, I feel like it can be your base case, albeit with elevated volatility at the same time. That makes it a little more tricky.
Yeah.
We think that there are plenty of reasons to be optimistic about the U.S. economy as well as markets. However, optimism is a lot more crowded today than it was last year or 2 years ago, which means that, yes, you can get upside, but there's a lot less buffer or cushion if you get downside surprises. So to us, what that translates to is a wide, choppy range for the year. We think that you could be up 10% or down 10%. It actually matters a lot less of where you finish the year in the overall return. It's what you do with the volatility over the course of the year, because we think you are going to get that volatility.